2020 has arguably been the craziest year I've participated in. Since before I began investing several months ago, I must say I feel terrible for those early investors out there who have been entering the stock market because it's really hard to navigate these treacherous waters if you do not understand what you've been doing. And that's the main reason why I'm doing this video. I want to create a structure that is going to help you navigate through them. Let's just say exciting times and not get roasted. It's not going to make you an investment genius in one video, but what it will do is set you on a proper track to invest successfully during tumultuous times. I'd like to share with you 5 things that I've learned through the years that have worked for me. Top investors like Warren Buffett rely on these strategies to outperform the market over the long run. Let's get right down to business, shall we? Those who are able to control their emotions will be the ones that stand out from the rest of the pack during these challenging times. To put it another way, Jordan Peterson suggests that we be the trustworthy ones at our loved one's funeral. It's critical that we apply that guidance to investing, especially in and after a market crisis, in order to make the most of it. You see, this is the attitude that 90% of investors adopt when their equities rise. Having earned a lot of money, they head to the pub and tell their friends about it. People's emotions are tied to stock market fluctuations, and they monitor their portfolios on a monthly or even daily basis. However, the greatest investors are those who do the opposite of what other people are doing. It's really a good thing for investors to see their stock prices fall, since it indicates that they may purchase more at a lower price. They realize that, in the long run, the lower the price at which they purchase equities, the greater their profits will be. Buffett explains that he believes what he believes because of this very principle. A lot of individuals in the marketplace are naive. In this casino-like environment, everyone is boozing and buying cheap and selling high. Sadly, most investors do the opposite if you want to get an edge over your competition. It's important to invest in sectors you're familiar with to obtain the best profits. That's why I propose taking a step back and looking at what you're good at. If you're a young man, you may be interested in gaming, artificial intelligence, social networking, or working for a technology-related company. In established companies, you may have an advantage if you are older. For Buffett, the only company models he understands, well, are the ones that offer sweet things such as See's Candy. Its business model has been around for a long time, and Buffett is aware of that. Insurance is one area where Buffett has spent a great deal of time studying and mastering the game. As a result, he is able to identify firms that are sound investments, and you should do the same. Gaming is a popular pastime for young people, so if you're interested in the future of the industry, you may have a better sense of which firms and industries will succeed than other people. Thus, one of Peter Lynch's most famous quotations is so simple but so profound. Know what you possess and know why you own it, he advises his audience. As you can see, investors are always looking for a return on their money. At the bar, they want to tell their buddies about all their firms, but they seldom stay within their areas of expertise. Most people don't know what they possess or why they own it. There are several reasons to avoid acting like most investors. What if I approach a complete stranger who had never played poker before and said, "Would you want to join me and my pals for a game of poker?" If someone offered to put up $500 and said yes to the game, that person would be a fool because he had never played before and would undoubtedly lose his money. If we apply this to the stock market, you'd be surprised at how many new investors lack basic knowledge about investing and end up losing their money after a year, 2 years, or 3 years. When it comes to stock market investing, especially in these uncertain times, here are some essentials you should know, okay? PE ratio. To put it simply, it gauges how much you pay for a stock in relation to the amount of money it generates. Additionally, the return of equity, or ROE. Stock market orders are a wonderful way to gauge a company's ability to generate profits. Do you know what they are? What exactly is a limit order? Is it a buy or sell order? A stop-lose limit order? Before you invest, you should be aware of these points. You may apply a variety of basic tactics such as Warren Buffett's method of valuing investing to your advantage, buying at a discount to its true worth. Is the dividend aristocrat approach something you've heard of? You can choose one or more equities in which you can dollar cost average and yet outperform the market over time. Before becoming an investor, you should familiarize yourself with these basic methods and approaches, as well as the PE ratios. Investing in this rule is one of the most straightforward, but also one of the most difficult rules to adhere to. Stock market news is all-consuming for investors who follow it religiously from one week to the next. Every time you get a bit of good news, you get a dopamine rush. It's a short-term fix for 90% of investors, so they'll keep an eye on the market. This is okay by me, but it has a detrimental impact on your investment strategy and eventually your results. One of the drawbacks of focusing only on the immediate present is that you missed out on long-term trends. Over the course of a week or even a month, the stock market tends to show just the tiniest blips of a larger trend. You'll make poor investment decisions if you're too focused on the near term as an investor, which will lead to lower overall returns. This is why Warren Buffett advises investors to only purchase something you'd be pleased to own for 10 years if the market shuts down. Don't obsess about the details or the daily headlines. Next, you'll want to get your mind around market cycles, particularly in 2022 when we're in the latter phases of the cycle. What I'm referring to now is gaining a handle on which stock perform well and when. Here's an old school graph to guide you in the right direction. As you can see, stocks in the transportation, technology, and the capital goods sectors tend to perform well in the early to mid-cycle periods of the market cycle. Why? Because the economy is heating up. Transportation is becoming more necessary. Technology, for example, 10 years ago was the best moment to invest in Netflix, Tesla, or Amazon, since the stock market was just beginning to heat up at that point in time. Contrary to popular belief, more conservative equities tend to do better in the latter phases of a cycle: healthcare and non-cyclical consumer goods. What's the reason behind this? People still need to eat, even during a financial slump. They require toothpaste, soap, and water, among other things. As a result, non-cyclical consumer goods are better investments. In the latter phases, healthcare stocks are also useful since they must be taken care of. And that's why I'm referring to here. If you're just staring out in the stock market, you'll want to familiarize yourself with these terms and concepts. You must be aware of which stock perform well and at what times. The old adage is that even if you purchase the world's strongest stock, if it's in the poor industry, you lose money. Ray Dalio provides historical facts and ties them back to give us an understanding of where we are in the current market cycle, so that I may plan my portfolio accordingly for market circumstances in 2022, which is why I follow him. As a new investor, you may wish you had started investing 10 years ago when the economy and the market were in their infancy, but for the time of being, you must focus on what the current market conditions, and these little tips that I've shared with you will help guide you through the waters of these unique market conditions in 2022. Finally, I wish you all the best of success in the future and hope that you achieve your financial goals.